enterprise risk management. We've talked about, a lot of this has been around, and kind of our philosophy is we start with traditional insurance and see, are there ways to make their existing insurance more efficient? But then there's also, when you look at businesses, there are some businesses where they don't really spend any money on insurance because as the business owner, they just decided, you know what? I'm not spending it because I think the bottom line for all of our clients, the common thread is they all dislike paying insurance premiums.
Mhm.
They dislike it a little bit less when it's their own insurance company, but they still view it as an insurance company. Um, so, can you give us your thoughts on enterprise risk management in a captive? And then also some of the thought on, I don't know, setting premiums or how do you look at enterprise risk management?
Well, so enterprise risk management comes down to identifying your risks and then determining what you're going to do about it. So a lot of what we do comes down to deciding whether or not that risk should be transferred to someone else, like this separate entity that the company owns that's a captive. So they're transferring it from the business that they own to the captive. And by separating their risk and transferring it to another company, that gives them the option to stabilize their income in their main company, which is the main reason why we buy insurance anyways, right? Not everybody can drop 400 grand on a new house because their house burned down. And so they buy homeowners insurance so that if it happens, they can get a new house. Same thing with the business, but usually they can almost always buy insurance that's required, and they can only sometimes afford to buy insurance that would be nice to have. And
Yeah.
if the business finds themselves in a position where they can buy the coverage for the other things that could sink their business, that could be the best approach for them in their enterprise risk management framework. Yeah, in the framework, you can choose to avoid the risks, you can choose to transfer the risks. But if you can't choose to avoid the risk, you can't choose to not operate in the industry you operate in,
Yeah.
then you have to treat that risk somehow. And if you decide to transfer it, then you have to find an insurance partner that's willing to take the risk. And what we find with enterprise risk management, not all the risks that the companies have a market for insurance policies. There may not be a company sitting out there taking legal expense risks like we mentioned earlier, or there might not be one that's willing to write business interruption that includes infectious disease, or
Yep.
that includes cyber attacks. And those types of business interruption claims could be covered on your captive policy, because you could have some sway with the captive manager or the risk manager and say, I'm really worried about this. I don't want to have to buy a business interruption policy that excludes anything that doesn't have physical damage connected to it. Yes, I think anyone who's ever bought into a 401k at work, they've talked to their investment advisor, and the investment advisor says, well, you want your stock portfolio to be diversified. You don't want one company to go down and your whole stock portfolio from Enron go down with it, right? So diversification works, and it works in all types of financial institutions. If you take multiple variables and you put them together, as long as those variables aren't all connected to each other and behave the exact same way, then they can diversify each other. So looking at a risk and then adding another independent risk to that, you get a less risky outcome than you did when you just had one risk.